Welcome back to the channel, everyone. Today I want to talk about how it's finally happening. Retail is being blamed for the market crash and for the coming AMC squeeze. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, you may remember back at the start of all of this, back in June and July, I said that retail investors would one day be blamed for the market crashing. I said that one day, whether AMC squeezes first and then the market crashes, we'll be blamed. Or if the market crashes first, causing the AMC squeeze, we'll still get the blame as well. These big institutions, these big hedge funds and the mainstream media need to pin the blame on somebody to suggest that they aren't the ones that crashed the market. They're going to spin the narrative that these big institutions and hedge funds need a bailout from the general public because of these horrible meme stock retail investors that caused the market crash. They're going to convince the everyday American that Wall Street needs a bailout and needs their money to protect Wall Street from those evil retail investors. Those retail investors that bought and held the AMC stock, causing market turmoils and effectively causing the market to crash. The mainstream media are obviously going to say, guys, we told you so, we tried to warn you of these horrible retail investors, and now look at what's happened. Wall Street needs a bailout to survive and to protect your money. But obviously, let's be clear, the market isn't crashing as a result of retail investors. The market is crashing due to these massively over-leveraged longs and these massively over-leveraged shorts that won't admit defeat and close their long position. They're consistently trying to pump the market more and more and more every single day so they can meet their margin requirements and they won't be forced to close out of their shorts. And instead of doing the responsible thing and admitting defeat and closing out of their short positions, they continue to pump the market and continue to add to their short positions. And now they're at the point where they can't close or they'll bankrupt not only their own hedge fund, but potentially the entire financial system. We, the retail investors, buying and holding stocks isn't causing a market crash. It's effectively our way of fighting back against the corruption on Wall Street. And obviously it is working because Wall Street is panicking more and more and more every single day because they know they've reached the end of the line in terms of pumping the market and everything is starting to collapse around them. So let's hear what Fox has to say and how they're blaming the market crash on us retail investors.
The meme traders who bought the AMCs and the Pelotons and the GameStops, they haven't sold out yet. So a lot of folks are saying these guys lost a lot of money. Many of them are still in the market. Some of them really don't know what they're doing because they're novice amateur traders who started when they were bored and they don't really know much about stocks. We can't figure out when the real bottom of the overall market is that our 401ks are invested in because the meme guys are still there. They don't know when to exit. Maybe they won't.
Wow.
So it's creating this broader problem anyways.
Very.
And there we have it. Fox is saying that we're creating a broader problem because we don't know when to cut our losses and we don't know when to sell. The mainstream media is suggesting that because we haven't sold yet, a true bottom of the stock market hasn't yet been reached, and therefore they don't really know what's going on with the market and how much further it has to fall. And now I think this is very, very interesting for two main reasons. I think it's important to remember that while retail investors do hold 90% of the float of AMC, that is not the same with the majority of companies in the S&P 500 or in the overall stock market. The majority of stocks have a very small retail investor holding, where the majority of shares are actually held by these large institutions and these big hedge funds. Obviously, the majority of stocks in the market, like Amazon, are being held mostly by institutional investors. Institutions hold 72% of Amazon. You've got 10% or more being held by insiders and more being held by ETFs and mutual funds. Retail investors actually only hold 0.45% of the Amazon float. And therefore, even though that 0.45% of the float may not have sold their Amazon shares just yet, that doesn't really impact Amazon's price whatsoever. Obviously, this 0.45% of the float being held by retail investors doesn't matter to Amazon and doesn't matter to the majority of stocks in the S&P 500. Retail investors are only really impacting these meme stocks like AMC and GameStop. And obviously the mainstream media is trying to pin the entire market crash just on retail investors holding some AMC shares. And while technically that is true and the market is likely to crash, it's not likely to crash because of retail investors. It's going to crash because these over-leveraged funds won't close out of their positions. And not only because they won't close out of their positions, they're willing to manipulate the entire market and willing to manipulate the entire S&P 500 just so they don't have the close. But obviously it will get to the point when the market crashes and these funds end up being forcibly liquidated and forced to cover their short positions. And guys, if you didn't already know, you can currently get up to 5 free stocks worth up to $3,500 each and a free share of Twitter on top of that, just for signing up with Moomoo using the link in the description below and making your first deposit. And Moomoo and Futu have also officially announced that Futu does not accept payment for order flow, and therefore you don't have to worry about your trades going through sketchy dark pools or being given to Citadel. Moomoo was also recently awarded the best trading platform at the FinTech Breakthrough Awards. Moomoo is very easy to use, it's incredibly customizable, and it will help you to trade like a pro. Moomoo has tons of technical indicators and advanced charting tools. Moomoo publishes daily short selling data, position cost distribution, and much more. So guys, be sure to sign up to Moomoo to get up to $17,500 in free stocks and a free share of Twitter on top of that by signing up in the link below. As True Demon tweeted, saying this narrative being circulated is absolute rubbish. Holding stock is what holds the price up, not what causes it to fall. He said this is the biggest fallacy to be shown on mainstream media since Trump's tan. And Hang Loose replied saying mainstream media just 100% confirmed market manipulation has been taking place for over a year by dropping the price of meme stocks illegally. He said the Indicate apes have not been selling, which means there is no other possible explanation for the price declining aside from the fraud. Because it's also been confirmed that institutes also haven't been selling their AMC stock either. He said so there's literally nothing but fraud that can explain this 80% drop in price. Obviously, looking at this institutional holding or this institutional ownership, those large institutions have only ever increased their AMC share holdings and have also never sold. And therefore, if institutions are buying and retail investors are buying, the only thing that can push the price of AMC down is market manipulation, because we know the entire float has been sold and at this point been sold many times over. But it's also not just the stock market that's in turmoil, it's also the crypto market as well. The crypto market isn't just crashing, it's basically being flipped upside down. Kobe tweeted saying, in case you want to know what the Mt. Gox unwinding felt like at the time, it was a little bit like the last 24 hours. Now, if you haven't been into crypto for that long, you may not know what Mt. Gox is and what the Mt. Gox unwinding actually refers to, or what's happened over the last 24 hours. Unusual Whales tweeted saying Binance has temporarily stopped all Luna withdrawals as of 10 minutes ago because Luna's stablecoin depegged earlier today. So there's a number of different stablecoins in the market like USDT or Tether, USDC or USD coin, and Luna stablecoin, which is UST. So these stablecoins are supposed to be pegged to the US dollar, just like once upon a time how the US dollar was underpinned or was pegged by tangible physical gold. Every single 1 USDT or 1 USDC or 1 UST should be pegged by one individual tangible US dollar. And therefore, when you exchange your Bitcoin, instead of selling off your Bitcoin into actual dollars, you can just exchange your Bitcoin temporarily into USDT or another stablecoin. Stablecoins are supposed to be a safe way in the crypto universe to lend money to one another, where that money is tangibly underpinned by dollars and therefore doesn't fluctuate with the volatility of crypto. But in the last 24 hours, users have been reporting that it's currently physically not possible to sell UST or Terra USD on Binance below 70 cents per coin. We can see the price of UST over the last few days where it had previously stayed around this $1 mark, but over the last few hours fell drastically. And Binance is trying to preserve UST or Luna by setting a price floor of 70 cents and physically not allowing any trades to be placed lower than 70 cents per coin. Binance is literally trying to prevent the entire crypto market from physically unraveling right before our very eyes. And Gold Telegraph tweeted saying, breaking news, the Fed is warning that stablecoins are vulnerable to runs, similarly to how banks are vulnerable to a bank run. Obviously, if these institutions and retail investors withdraw the money they have invested into these stablecoins, it can effectively cause a stablecoin run. And if you didn't catch this, a very large institution was just liquidated for their entire Luna holdings. Rec tweeted saying liquidated long on Luna USDT, selling 225 million coins at $35 per coin. And therefore, if you run the math, that's 225 million coins times $35 per coin, which is around $8.7 billion that was just liquidated. For a fund to be liquidated in this way, they would have had to have been leveraging their long position on Luna. Therefore, they had obviously borrowed money against that $8.7 billion position and had to pay it back, and that's why they were being liquidated, to pay the loan back. But even at a 10 times leverage position, that's still $870 million of the fund's original cash that was just liquidated. And obviously, as a result of the current stock market position and the current crypto market position, Zero Hedge just tweeted saying the Fed has warned of worsening financial liquidity in their most recent stability report. You may remember in the most recent stability report, before this one, the Fed warned that the market could crash as a result of meme stocks and their volatility. And now the Fed is warning that financial liquidity is worsening even more. And even though the stock market is currently crashing and the crypto market is currently crashing as well, Mac10 tweeted saying somehow there is still no sign of fear in this current market. Even though the market is currently crashing, the buy the drop crowd is still buying all the way down, thinking the market is going to surge upwards and set new all-time highs in a matter of only a few days. If we look at the Nasdaq composite and the number of stocks in the Nasdaq setting new lows, we can see the Nasdaq recently broke past the March and January lows and set new lows for the Nasdaq. And there's also a new high of the number of stocks inside the Nasdaq that have hit their lowest point yet. This is showing the market crash is absolutely continuing, and we're likely to see even more stocks hit new all-time lows and likely to see the Nasdaq continue to fall. And the DTCC seems to be warning of further market lows and a further market crash. The DTCC tweeted saying as the nature of risk continues to evolve and the black swan events occur with greater frequency, we're highlighting the top systemic risks that pose increased contagion threat. And as Matthew quoted, black swan events occur with greater frequency. The DTCC said events as in plural, as in multiple black swan events, and he's ready to watch history being made. We're currently seeing multiple black swan events and likely to see multiple more black swan events as the market continues to crash. And finally, as Michael tweeted, he said there's never been a period in history where the disparity between stocks and bonds has been this vicious. Not in 2020, not in 2008, and not even during the 1970s. He said what is happening here is the mother of all black swan events. Guys, be sure to let me know down in the comments below what you think about retail investors being blamed for the market crash and how it's finally happening. And as always, guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.